You are listening to Insights from the Conference Board.
Hello, my name is Ilaria Maselli, Senior Economist at the Conference Board, and it's a pleasure to welcome you to this edition of Indications Podcast, a series brought to you by the Conference Board. Today, I will be sitting down with my colleague Klaas Vries to discuss some of the insights from our work of the last weeks, where we try to answer questions like: what is the impact of the November lockdown on growth in Europe? What can we expect for 2021? And is there a risk that the impact of the pandemic shock will scar the European economy for the whole decade? Hello, Klaas. How are you today?
Hey, Ilaria. Thanks for having me.
Very happy to have this chat with you. So, Klaas, I propose that we start with growth in Q3 because GDP growth in the euro area was 12.6% in the third quarter compared to the second quarter of this year, and in some countries it almost reached 20%. So the recovery in Q3 was much stronger than consensus estimate. So, Klaas, tell me, where did we all get it wrong?
Yeah, good question. Well, first of all, I don't think it's not that we completely didn't see it coming. I mean, we have monthly data on retail sales were very strong. For some countries, it quickly rebounded to pre-pandemic levels. Industrial production, also released on a monthly basis, was very strong, even though it didn't rebound that quickly, but still, it was very strong. And then we had the PMIs, the Purchasing Manager Indices, which were also going back to above the 50 level, which signals expansion very quickly. But it was, yeah, I guess it was difficult to piece everything together and to see how strong the recovery actually was, right? Because GDP is a sort of more aggregate measure of activity. So it was difficult to combine these different measures. And I think also a lot of what is in GDP is not measured on a, or at least the data is not released on a very timely basis. So a lot of service sector activity, for example. And then, of course, public services is also in GDP, and that in some countries that also had a pretty strong impact. I think there have been some other elements as well in the background. If you remember, in the spring, there were a lot of discussions around which letter the form of the recovery would take. Right? Was it a V or a U or a L? And I think most economists were more sort of on the pessimistic side. Because initially a lot of people said, look, it's going to be a V shape. It's just a quick lockdown. After that, everything we're going to restart everything, and things will be back to normal. A lot of economists questioned that. We were actually one of those. About the idea that you could put the economy in the freezer and then defrost it very quickly, so to say, and then things would be back to normal. And given all the interlinkages that we have in the not just in domestic economies, but across borders. And also what we know from previous research on pandemics, how it can hit consumer and business confidence for years to come. So I think that was also playing in the background, that economists in general were a bit more on the pessimistic side. And I think there is still some truth to that argument. And also, you see, I mean, we haven't recovered fully, but it wasn't as dire, I think, as many of us thought it was.
So basically, the Q figures are teaching us that economies can rebound quickly eventually.
Exactly. Yeah.
So let me recap this turbulent year from the economic point of view. And it's been turbulent from many points of view, but I will just recap the economic one. So basically, growth in Europe was normal in January and February. Then there was a major drop in March and April during the first lockdown. Then there was a stronger than expected recovery between May and August. And now basically we are in the last months of the year, and what happened is that the virus started to circulate again aggressively since September, and unfortunately many people are dying every day in Europe in the last weeks. So at the end of October or beginning of November, many countries announced restrictions, and we expect those to stay for the rest of the winter somehow. So, Klaas, the question I want to ask you is, how is economic activity going in November?
Yeah. So obviously November hasn't even passed yet, but yeah, indeed we do have some data points already. For example, the Google mobility data, which is released on a daily basis actually. And basically it tracks movements of people to shops or other places where they can spend their money. So it's a good proxy for economic activity. And from these mobility indicators, we see that the current lockdown, at least so far, but I think it's unlikely to go deeper at this stage. But at least so far, it's about half as what we saw in the spring. So based on those measures, you would say that the impact on mobility and the economy is about half as what it was in the spring. Now, the mobility data is one. We have other measures as well. The flash PMIs, the Purchasing Manager Indices, have been released just 2 days ago, which is also a very timely indicator. Now, we find the flash PMIs are a bit stronger, have a stronger link with economic activity than the mobility indices, and so we have a model where we basically model the impact of the PMIs on the GDP. And again, here we are. Our model is suggesting that November lockdown so far is about half, or a little bit less than half, of the impact in the spring. And
So
again,
the
there's
decline in activity, if I understand correctly, the decline
yes,
in activity is about half in the current November lockdown compared to what we saw in March and April.
yeah, and again, the country, the difference between countries is also relatively similar. So in France, UK, and Italy, again, we see the strictest lockdown and the strongest corresponding drop in activity. And Germany, again, it's a bit more muted than in the other countries. And in Spain, interestingly, in the early lockdown, the spring lockdown, they were really among the worst hit countries, but this time they seem to be more or less in the middle between those countries. But of course, I mean, we have to wait until more firm data comes out to make a good, really proper estimation. But this is what we're seeing so far.
I see. And there is another data point that we just released, and that's the Conference Board measure of CEO confidence for Europe by the European Roundtable for Industry. So it's a survey of CEOs that we ran in the second half of October. And I think there were some interesting and encouraging results there because basically the survey was run at a time that COVID was spreading aggressively here. And despite that, industrial leaders are cautiously optimistic, I would say, about the business prospect for the next 6 months. So in the second half of 2020, the confidence rose to 61, which is a remarkable rebound from 34 in the first half of the year. And just for everybody to be on the same page, a score above 50 means that there are more positive than negative responses. So the vast majority of CEOs surveyed report that the economy is doing moderately or substantially better compared to 6 months ago. They even expect sales and investment to go up in the next 6 months. So the only clear negative note in the survey that comes out from the survey is unemployment, which they expect to decline in the next 6 months. Now, we're going to take a short break for a quick announcement and be back in just a minute to continue this conversation with Klaas and Vries on where the economy is heading in 2021 and beyond.
Looking for additional business insights in this subject area and beyond this podcast? Go to tcb.org/EU and explore our Economy, Strategy and Finance Centre. Uncover a large array of products hosted by the Conference Board in focus areas like global economy, labour markets and many others. Products include peer-to-peer networking events, expert briefings, publications, data and analysis, webcasts, videos and blogs.
Last summer, we prepared 2 scenarios for growth in 2021, and I think they're still valid. We keep switching our preference on which one of the two is the baseline scenario, but here we are. So in the first scenario, we expect a stronger rebound for the economy as COVID-19 is controlled, which means basically that the outbreaks are handled with a mix of better medical treatment and a vaccine is available and rolled out during the year. In that case, the economic recovery takes hold, supported by low interest rates, ample fiscal stimulus, and limited employment losses. In scenario 2, we expect a weaker rebound as COVID-19 continues to circulate and there is no vaccine to rescue us, which translates for the economy into a stalling of the recovery, both on the supply side through severe restrictions on activity and on the demand side through a loss of confidence. And in that case, an increase in unemployment and ineffective economic policy add to the drag on growth. Klaas, how do we translate these scenarios into numbers?
Yeah, so our baseline scenario, scenario one, as you describe it, would lead to a growth rebound of about 5 to 6%. And mind you, this year we are looking at about minus 8%. In the second scenario, which is of course a lot more negative, we are looking for growth of about 2 to 3%. So very weak, still strong growth, of course, but very weak from the numbers we see this year.
Especially considering the depth of the recession this year.
Exactly. Of course, there's base effects indeed that play a large role in these numbers, interpreting these numbers. Now, for the US, we also prepared scenarios. Here, we actually added a more positive scenario next to the baseline and the pessimistic scenario. And here we also look at factors like the fiscal stimulus assumptions. Will they be able to agree to extend the fiscal stimulus there? And also more domestic political issues like the political transition. How will it go? And for the US, the different, I mean, our baseline scenario is around 3% of growth next year. First, and for the US this year, it's minus 3%. But in a positive scenario, it can go up as much as 6%, or be close to zero in the downside scenario.
Thank you, Klaas, for the numbers. And I want to ask you something else because a very specific characteristic of the current economic crisis is how different basically it is by sector in a way that we didn't see before. This is why I think we're working with a model that looks at each industry. And so, can you give us more details on the expectations for each sector?
Yeah, so I think I mean we already talked a little bit about retail trade that really recovered very quickly. I think there was also part of that was people were not able to spend on other services like going to restaurant or hotels or whatever. So I mean there must have been some switch there to more consumption of goods. And then you have manufacturing, which took a very deep hit in the spring, but has recovered relatively quickly. And also, I think in this lockdown, it shouldn't be that much affected because we see that the restrictions are mostly on service or face-to-face economic activities, which are mostly in the services sector. So the manufacturing recovery should continue throughout this new lockdown. But then again, of course, I mean, hotels, restaurants, entertainment sector, that is where we are mostly pessimistic in terms of our forecast. So even if life is back to normal by the end of next year, which is what a lot of commentators are suggesting currently, because of the vaccine rollout, the question, of course, is still how much business are still left, right, in that sector? How much have survived? We haven't seen a lot of bankruptcies yet, but that of course can still come. I guess what I want to add here is that you can go a level deeper. Of course, we're talking about sectors, but within sectors, there's also winners and losers. For example, within the restaurant business, we know that McDonald's, for example, has done pretty well actually. They really ramped up their digital transformation. They ramped up their online offering, their takeaway offering. So it's not a clear-cut picture in that sense between sectors. Even within sectors, you see these differences.
I see. And I think there is another element that is important if we look at next year. And there is, of course, a lot of discussions here in Brussels around that, and that's the Next Generation EU. So in July, the European Union launched a package of grants and loans worth 750 billion euros to stimulate the economy. And The main program in there is the Recovery and Resilience Facility, which amounts to 560 billion euros, of which 250 will be distributed to member countries as loans and 310 as grants. So the latter is actually the big novelty of the package, as it created a form of cross-country redistribution and a form of solidarity. So basically, what we saw this year, and will have probably an impact on next year, is the fact that these unprecedented economic challenges generated a new joint fiscal response. So, what I want to ask you, Klaas, is that taken into account in our forecast, and will that significantly push up growth in 2021?
Yeah, no, of course we looked at those numbers, and yes, for some countries we do think it can have quite an impact. So just to recall, the money is distributed according to economic fundamentals like GDP per capita, unemployment rates. So based on that, you can already figure that a lot of the funds will go to Eastern European countries where GDP per capita levels are lower, and Southern European countries where unemployment rates are typically much higher. Um, Estimates are that the support is in the range of 3 to 5% of each nation's economy year over year in the next sort of 3 to 4 years. And just to put it into perspective, usually in a typical year, about 20% of GDP is going to investment. So it's a significant amount, I would say. I guess the question is, when will it kick in? Maybe even 2021 is a little bit too early for it to really have an impact on the activity figures. There are still conversations in Parliament, right? Whether it can go through. And then there are more mundane issues like, do countries have? I mean, they have to prepare project proposals for the money to be spent to unlock the funding, right? So, I mean, there are some things that can cause it to take a little bit of time before it kicks in.
I see. And now let's try to look beyond 2021, because at the conference board, we have a model to estimate growth for the next decade in 77 countries. And Klaas is actually the main engineer of this model. There is a lot of things that are interesting from there. But one thing I really learned from the exercise of this year is that the strength of the recovery, the magnitude of the recovery in 2021 can really impact the following years. A weak 2021 means that European economies will close the decade with a lower level of GDP compared to our estimates of last year, when we didn't know that the pandemic was coming. And this sounds very abstract, probably, but to make it practical, it means that the longer the COVID-19 health crisis persists, the longer the risk of permanent damage to the economy, which can happen through a loss of capacity in sectors that are particularly impacted by social distancing, like hospitality, food, personal and business services, cultural activities, all that you mentioned, Klaas, before. So, in a situation where the supply of those services is constrained by COVID, normal market adjustment, which would happen, cannot happen, and these can be price adjustments, can be mergers, takeovers, new companies. All of this, it's very difficult to happen in this strange moment. So, if this continues, basically, a temporary increase in unemployment can become long-lasting, as workers find it difficult to re-enter the labor market. And we also know from past crises that major economic shocks also tend to affect future opportunities and incomes for young people that are finishing school or university this year. And this effect can persist over the course of their lives. So this was really my big takeaway from the exercise of this year. And I'm curious to hear, Klaas, what is your main takeaway from our long-term estimate?
Yeah, I agree with you. I mean, that was for me. That was also a bit of a surprise. I guess I would have expected some somewhat quicker growth rates than we had estimated last year, given the I mean the recovery, the bounce back. But the model, indeed, as you explained, I mean, it doesn't really foresee a strong enough pickup in the next 5 to 10 years that all this lost output will be recovered. And when we looked a little bit closer into the details on where that lost output, where is it coming from? We found that a lot of that, partly it's employment, of course, as you explain, some permanent scarring to the labor market. Part of it is a small part of it is in productivity losses. But the biggest one is in the investment shortfall. So apparently the model doesn't expect investment to recover very quickly in that sense, to recover all the lost investment that hasn't happened in the last half year, let's say.
I see. I have to say our time is up for today. So thank you, Klaas, for sharing the insights from our work on the European economy of the last months. And thanks everybody for following this program. If you enjoyed this episode, please remember to subscribe to our Indications podcast series or explore the entire catalog of podcasts from the conference board on our website. Thank you and goodbye.
This has been Insights from the Conference Board.